I'm Diane Rusignola with NAREIT, and in conjunction with NAREIT's REIT World, I'm here today with Jason Fox, CEO of WP Carey Inc. Jason, how are you today?
I'm doing great. Thanks for having me, Diane.
You resumed acquisition activity in the third quarter after pausing over the summer. Can you talk about some of your recent deals and what makes you competitive in the current environment?
Yeah, sure. I mean, a big part of that was that despite investment activity being on pause following the first wave of the pandemic, we stayed in close communication with our tenants and brokers, and really given the strength of our balance sheet and significant liquidity, not to mention our confidence in the strength of our portfolio, given our high collection rates, we were in a strong position to resume external investments when deal flow picked up again. And now since September, we've completed several deals, the large majority of which were industrial properties and really exemplify the types of transactions we focus on. These are sale leasebacks of operationally critical properties. They tend to be market leading tenants, which are also large, well-capitalized companies. And we structure them on long lease terms with good built-in rent growth. And I'll give you a couple examples. We completed a $44 million sale leaseback of two highly critical industrial facilities in the Midwest. This was on a term of 25 years, net lease to an industry-leading snack food manufacturer. Another deal was a $40 million sale leaseback of a light manufacturing facility near Chicago's O'Hare Airport. That was leased to Weber Grills, the well-known leader in barbecue grills and accessories. Very strong company, great asset, and that was leased for a term of 15 years. And then more recently, we did a $34 million sale leaseback of a refrigerated food processing and distribution facility that was net leased to a leading distributor of specialty produce in the Midwest. That's within the Minneapolis MSA. We continue to do off-market deals with our existing tenants, which remain a real significant source of investments for us. In the third quarter, we completed a $28 million, 300,000 square foot expansion of a warehouse in Portugal, and that was with an existing tenant called Sonai. It's one of Portugal's largest food retailers. The expansion was added to the original lease, which as part of the deal, that lease was extended by 10 years to a new 20-year lease term. So we got some added benefits there as well. I think it's also worth mentioning that property includes a 4,000 megawatt solar roof installation, and it's also been approved for LEED Gold certification. I think lastly, a deal we just announced earlier this week is a $102 million sale leaseback of a 27 property supermarket portfolio located in northern Spain and the Balearic Islands. That's leased to one of our existing tenants, a company called Eroski, which is one of the largest food retailers in Spain. So, our activity has really picked up. We have a growing pipeline, so you should see more interesting deal announcements from us as we finish off the year.
With close to 100% of rent collections, what factors have helped contribute to such strong collections?
Yeah, and during the pandemic, our portfolio has to date, shown remarkable resiliency and consistency across all property types and geographies. And most recently, we had 98% rent collections for rent due in the third quarter and 99% of rent collections for October, which is sector leading. It's really a testament to our deep credit underwriting and investment strategy focused on acquiring mission critical assets from creditworthy companies. We also take a long-term approach, evaluating every new investment based not only on how we think they'll do during times of expansion, but also how they will perform during times of distress. And that's made a big difference. We view our tenants, or we view tenants that are just below investment grade as providing the most attractive risk-reward trade-off. We also focus on large companies, which are generally better equipped to weather downturns due to their better access to liquidity, and in a worst case scenario are much more likely to restructure and continue to operate, as opposed to smaller companies, which are more likely to liquidate and potentially disappear. Let me put some numbers on it. So 97% of our annualized rent comes from tenants where they or their parent company generate over $100 million in annual revenue. So these are sizable companies with access to different forms of capital. Of course, we've also always believed that a well-diversified approach is the best way to invest in net lease. It provides wider opportunity set for external growth. But I think in times like this, it's important that it also protects us from overexposure to any single asset type or industry, and that's been important during the pandemic. And I think it's worth mentioning, within our diversified model, we've also maintained an underweight approach to retail, which makes up just 17% of ABR, with the vast majority of that in Europe, which in our mind has better supply dynamics for retail. Not to mention our retail in Europe is largely concentrated in grocery and home improvement, industries or asset classes that have fared very well during the pandemic. And on the flip side, we've also put greater emphasis on acquiring warehouse and industrial properties, which currently comprise just under 50% of our ABR. And that's certainly had a positive impact on our collections, and I would expect us to continue to overweight industrial assets going forward.
You've recently raised equity and debt capital. How has your recent capital markets activity helped position you for new deals?
Yeah, that's right. In June, we completed a forward equity offering for gross proceeds of about $382 million. And from that, we have about $166 million left to settle, effectively pre-funding the deals we have in our near-term pipeline. And importantly, that's at equity issued at a predetermined price. So I think it's also important to note that offering really expanded our ownership amongst the traditional REIT dedicated investors. And then in early October, we also completed a US bond deal raising $500 million in senior unsecured notes. And that was at a 2.4% coupon, which represented our tightest ever spread to the benchmark 10-year treasury. And it's also, we believe, the lowest ever coupon for a 10-year net lease bond. Both deals received very strong support from institutional investors, and that resulted in great execution and very attractive economics. So now we have significant liquidity to execute on new deals, almost $2 billion in liquidity, including a line of credit that's almost entirely undrawn as of the close of the third quarter. And equally important, we have a cost of capital that enables us to make accretive investments, and that's despite the tight cap rate environment. And that also includes the higher quality industrial assets, which continues to be a competitive area of the market. So yeah, the end result is that our balance sheet is very well positioned for a variety of economic and capital market environments, and that includes an environment with continued uncertainty from the pandemic.
Jason, thank you so much for your time today.
Great. Thank you, Diane.
For more from REIT World, visit REIT.com.